Continuing a weak start to the year, the stock market today falling the most in 2 months. So, has the market run out of steam and is on its way down for the foreseeable future? Well, maybe not. Joining us now, our financial panel, Rob Morgan, the CIO for Fulcrum Securities, David McElvaney, the CEO of McElvaney Financial, and Larry Shover, the CIO for SFG Alternatives. Boy, that's a mouthful. Rob, I'm starting with you. Okay, look, is this the start of the new trend? You're not supposed to fight the trend on Wall Street, right? This would seem to be developing into a trend.
Well, we're still early in the year, Jerry. Let's keep it all in perspective here. We're coming off one of the best years we've had in nearly 2 decades, and earnings season is just really getting started in earnest. So there really hasn't been necessarily a catalyst moving the market up, and people have been taking some profits. I took some myself. So I'm not sure. It could be a pullback, but I think it's too early to tell.
David, pullback or correction? What do you think it is? Down 179 on the Dow today.
I think it's a correction for a couple of reasons. One, it's tough to get an encore following 2013. You had amazingly high share buybacks from corporations in the hundreds of billions of dollars per quarter, and on top of that you had trillions of dollars floating in the system, which helped goose the stock market higher. I don't know. If you continue to do those two things, I suppose you could end up with a pretty strong year, but you'd have to see, again, record share buybacks, hundreds of billions, and Fed money printing into the trillions for the encore.
Wow, wow, wow. Larry, do you agree? Are we that far off the mark?
No, I think with this healthy digestion and consolidation, let's keep in mind, nothing has occurred since Christmas. This is after a trough to peak 4.5% rally in December, being up 12.5% in the S&P in the fourth quarter, and we know up 30% for the year. So it's just healthy digestion. It's what we need right now. I don't like it. My fund didn't perform very well today with the 1.5% break. But it's very, very healthy, and it gets people more bearish. It gets people to regurgitate all the rumors and all the things about valuations.
I tell you, this digestive problem is really getting to me. I mean, it's very uncomfortable, and I think a lot of people out there are getting a little nervous. Let's talk about the economic engine behind this. Are earnings holding up, Rob Morgan? And do you think consumers are going to get back in the saddle and spend?
I do think that earnings are holding up, Jerry. I think, even though they have been somewhat anemic, I would say, but keep in mind the market is forward-looking and it's looking for improvement in earnings, and I think you're seeing earnings estimates for the S&P 500 go up down the road. Consumer spending's been pretty anemic too, but you asked the question: Are consumers going to spend? I think we're going to see some continued improvement there as well, and that should help the economic backdrop.
David, you agree?
I think earnings are in a dangerous spot, frankly. We look at estimated earnings, price earnings multiples of over 15, actual, not the estimated, but the actual is over 17. And if you're doing GAAP-based accounting, which takes and puts back in those one-time items, you've got a price earnings multiple for the S&P of over 23. That's not exactly what you'd be looking for if you were a value investor. In fact, that would be sort of at the outer edge, and I think would go a long way to support a thesis that we're 50 to 70% overvalued at these levels.
Oh, wow. Larry, do you agree?
I kind of sort of agree, but I heard the same thing at the beginning of 2013. Not exactly. So I don't think stocks are overvalued. I do think the earnings season coming out is going to be good enough. It's not going to be great. It's going to be good enough to sustain the market. It surely will be harder to make money going forward, but I do believe that our earnings season is going to surprise some people, especially in the financials and the big bank scenarios.
Financials and big banks, big choices for a lot of people. There are a lot of folks out there who've been talking about industrials at the beginning of the month. I do want to mention as one more topic, though, on the economy. What about that jobs report on Friday, right?
Yeah.
74,000 jobs. Are you kidding me, Rob? Is this just a data point that 6 months from now we'll be laughing at, or is this something that's the start of a trend?
Well, it bears watching, certainly, but at the same time, it seems like it might be somewhat weather-related. There was a big drop in the construction area, and that's, of course, tied really to the weather. So we got, it's a big miss, and it is something to be concerned about, but it is just one point. And there are other economic there's other economic data out there that seems to show the economy continuing to firm. So,
David, if I hear one more person say, "Oh, Jerry, we would have done better except for it snowed in January. We never expected that to happen." What a shock!
No, listen. So this was a seasonally adjusted number. If you looked at a non-seasonally adjusted, you wouldn't have the rosy 70-odd thousand improvement. You would have been negative 246,000.
Wow.
So, I mean, I think you're actually looking at a pretty nasty number. The improvement to the rate, bringing us to 6.7%, is because the labor force continues to shrink. That's not what you want to drive that particular number. And then when you look at January's numbers, you've got 55,000 of those jobs which were retail, which go into the 74,000. 40,000 came from temps, and so I think you could actually have an even worse number, potentially, for your January number.
Wow. Larry, tell me it's not all going to hell in a handbasket, will you?
Well, yeah, for me, it was more of a confusing number than it was a disappointing number. And as David mentioned, I'm looking at the average hourly earnings, and that number, you can't talk past that. It's been bad for a long time. People are underemployed, not making enough money.
Right.
On an inflation-adjusted basis, I think wages are as low as they've been since World War II, not just for the past year, but on an inflation-adjusted basis. But it's not enough right now to change economic momentum, because the average is still, the 4-month average is still well above 150,000 ads. So it might be an anomaly. It might be noise from statistics or weather. Who knows? But looking deep into numbers, it is a little bit disconcerting.
All right, people worried about that one. Rob, Larry, and David, thanks for coming on. Appreciate your time. Great stuff.